Navigating an overheated market, insights for December 2024. So as we approach the end of the year, financial markets have experienced significant gains from large stock valuations to investor optimism. So it's critical to assess whether these trends are sustainable or showing an indication of potential risks. So this analysis unpacks critical factors shaping the markets, offering insights into opportunities and also potential warning signs. Okay, so let's pretty much get straight into it. So over the last 3 hours, I've been trying to record this video and it's been very frustrating to try and record it because I keep messing up this chart, but please just bear with me because I think it's very important to pay attention to these trend lines. Now, these trend lines go all the way back 1995. I'll give you some background on this chart, that this is the chart of the S&P 500 on a weekly time frame, and at the time of recording, the S&P 500 is pretty much at an all-time high. Now, like I was saying, that these trend lines go all the way back to 1995, and you can kind of see throughout the course of history, the S&P 500 has pretty much been using these lines as support and resistance. Like in 2002, it was used as support. In 2007, resistance. 2008 to 9, support. 2020, support. Again, resistance. During 2017 all the way up to 2020, back in 2021, resistance, and where we're currently at is we're currently at resistance. Now, it wouldn't really surprise me that we did see some type of pullback where the S&P is at the moment. I mean, we could obviously just go straight through it, but these trend lines have been a very good indication whether or not the market is going to react downside or on the upside, dependent on whether it's support or resistance. So you can kind of see it here in 2018, 2019, 2020, and again, like in 2023, 2022, throughout this whole entire year, like we retested it as support, retested it as support twice, and now we're currently at resistance. And like I was saying, like I wouldn't really be surprised is that if we kind of see some type of volatility to the downside. Now, what is also quite interesting, I know I mentioned this in my last video, but this is just in relation to the money supply. So what typically happens is when the market starts to correct, we start to print more money, and you start to see these large divergences between the money supply and the stock market. And then when the stock market doesn't have any more money in it, pretty much to kind of buy at higher prices, we then, as the market started to correct, we then obviously print more money. And this happens throughout the course of history, well, pretty much since 2008. So yeah, I mean, obviously where we currently are is we have this large divergence between the stock markets and the money supply. And one or two things pretty much need to happen, in my opinion. Either the market needs to come down or the money supply needs to go up. Now, there's a lot of optimism in the market at the moment in regards to interest rates coming down, and obviously with the new administration coming in, be cutting taxes and looking at different ways to kind of stimulate the economy. And obviously everyone is getting very long, and there's not really many bears about. And when you start to look at kind of traditional indicators, you can kind of see how these traditional indicators are pretty much at record time highs. Obviously, we've got here the S&P 500 price to book value is pretty much at a decade high. We've got the PE ratio, what is a very tasty valuation, at 30. We've got the Schiller ratio, what again is at a very tasty valuation at about 38. Price to sales, again, very expensive. And the Buffett indicator, just to give you some more context, the Buffett indicator is the total US stock market value divided by the gross domestic product, GDP. So at the moment, it's 208% overvalued. Now, the thing is, just because something is significantly overvalued doesn't necessarily mean that it's going to kind of correct tomorrow. It's just trying to figure out what is good value to kind of be buying in at or kind of selling into. And the thing is, I don't really know if the market is going to be going down or going up, but I just think looking at all of these different types of indicators, I think it just seems quite apparent that the market is quite tasty, but there is kind of obviously a lot of cash sat on the sidelines, what I kind of want to show you in a minute. This was quite interesting. What I kind of came across is that there's a lot of annualized inflows into US stocks. So we're pretty much at, again, another record high in terms of people getting an allocation into the US stock market. So at the moment, it's about 450 billion in terms of inflows into US stocks. And you can kind of, this is all over the news at the moment. And a lot of people are getting very excited about obviously crypto and using a lot of leveraged products. Now, a lot of people are wanting to get exposure to the leveraged Ethereum ETF for kind of obvious reasons. I mean, a lot of people believe that crypto is going to go absolutely crazy in the next couple of months. I mean, that might be the case, but the thing is, when you have so much leverage in the system, just expect a lot of volatility, because when everybody is so long, I don't know, for me anyway, it just makes me kind of want to take a bit of a short position just on the basis that everyone is significantly long. When you start to look at other areas that investors are flocking to, leveraged ETF bets, over 80 billion have inflowed into leveraged ETFs. Now, another area as well, what I think is interesting to look at is the single stock leveraged ETF volume. So a lot of people are taking out leveraged leveraged on single stocks, specifically Nvidia and MSTR. Now, when you have all of this leverage in the system and everyone is so optimistic, I just think you should be a little bit cautious. Now, what we pretty much have is retail and institution investors piling in, chasing momentum rather than fundamentals. Now, something else to kind of look at is there's a lot of money on the sidelines, especially in money market funds. Now, at the moment, we see there's about $6.5 trillion sat in money market funds, what obviously can be used in terms of stimulating the rest of the market. So if there's going to be a significant drop, I can kind of see how it would be bought up relatively quickly, because people would take their money out of money market funds and obviously pile back into the S&P 500, the NASDAQ, or all of these kind of like speculative names. As we transition into 2025, investors should brace for increased market volatility and potential corrections by staying disciplined, focusing on technical opportunities, and remaining up to date with macroeconomics. Now, this video has taken me a long time to actually do. I'm kind of a bit unsure if I should actually upload it, but anyway, hopefully you've got some value out of it. And to the 4 people who, or maybe 5 people who watch me, I hope you're having a lovely day, and I'll see you in the next video. Bye bye.